All right, folks, welcome to the April session of Macroeconomics Hours. Really happy to see all of you. Let me start. So today we'll be talking about global imbalances. So let me start sharing my screen. I'll start the presentation. I'll turn it over to Hadi. And Hadi will give a macroeconomic theory summary of the relevant topics, and then we'll get into the discussion of some of the Economist article and a couple of recent policy reports, right? Okay, so today we'll talk about global imbalances. We'll do, as I said, the summary of the economic theory and connections between trade deficits, national saving, and budget deficits. We'll talk about global imbalances now, versus what happened right before the great financial crisis about 20 years ago. We'll talk about their causes, risks, and policy challenges. And so the resources for today's discussion are the article by The Economist. There is a very recent report that just came out from the International Monetary Fund. And there is also a somewhat competing report from CEPR that provides their view, which tends to differ quite a bit from the International Monetary Fund report. And so I'll just do a quick definition of the global imbalances. So we can think about them as sustained, persistent cross-country disparities in saving and investment, which in turn lead to imbalances in trade, such as some countries having sustained trade deficits over a long period of time, and some countries having sustained trade surpluses. And as a reminder, of course, trade deficits is when your imports are greater than exports, and trade surpluses is the other way around. And so the outcome of that is that some countries tend to be net lenders, some countries tend to be net borrowers in the world. And the reason why this topic is important to us is there's a couple of things here. One of them is financial stability and the potential contribution of global imbalances to both national and world financial crises. Essentially, if you have significant capital flows from one country to another that take place over a long period of time, that could contribute to that. That can contribute to the asset bubble formation as well. And then there is, of course, the pressure on exchange rates and interest rates that comes from global imbalances as well. And finally, this can become a significant political and trade tension issue. And this is exactly the case right now, right? So with that, I'll stop sharing and pass the baton over to Hadi, who'll present the economic theory, and then I'll jump in with the discussion of recent events in the space. Hadi, go ahead. It's all yours.
Thank you. Let me share my screen. Just a second. Find my. Okay. All right. So thanks for the definitions and clarifying what the issues are generally. But I want to do very briefly to remind everybody about the connection between investment and saving, which is at the heart of this issue of deficits. We know from macroeconomic theory that the fundamental relationship between investment and savings is that total investment must be equal to total savings in any economy. This is always true. That's why the equality sign that I have here is an identity sign. It has three dashes, not just the two that equates one side to the other. These are the same thing. And the reason for this is rather easy to understand. If you want to invest something, that means that it's a product that you have produced and you don't want to consume it, you invest it. So that's also the definition of savings. The income that you get and the part that you don't consume, that becomes saving. Savings must be equal to investment at any time, because any dollar you want to invest, somebody must have saved it. Okay, now we need to get a little bit more into more detail here, because one key question is, where do savings come from? Investment goes to the country which we are looking at and studying. But where does the resources come for that investment? It could be domestic sources, domestic savings, or foreign savings. Foreign savings is the amount that foreigners have produced, have not consumed, and are providing it to us to consume or invest. And trade deficit is exactly that difference between, or the amount of savings that foreigners are providing for us. Because every dollar that foreigners give us to invest in our economy, and we are not getting any units of our production, we don't give them any units of our production in order to increase our investment. We need to be importing more than we're exporting, and therefore that becomes part of trade deficit. One more step here gives us a relationship which is very interesting. Investment must be equal to total domestic saving, as I said, and plus foreign savings. But domestic savings have two parts: domestic private savings and public savings. Now, public savings is the money that the government collects but does not spend. And that's known as budget surplus, the negative of budget deficit. Governments typically, almost all governments, tend to have budget deficits, which means that part of the domestic savings goes to or cover budget deficit. So this, let me get a pen here. Okay. If the government is running a deficit, this part is negative, and therefore that gets subtracted from domestic private savings. Private savings themselves can be savings by households or savings by corporations. Doesn't make much of a difference in macroeconomics. It's private agents, either firms or individuals, households, that provide the savings, and the firms or corporations belong to some people in the economy anyway at the end. So that's the total savings that private sector provides, plus budget surplus, which is usually a negative number, plus foreign savings, which is our trade deficit. Now, imbalances arise when either domestic private saving goes down, or in a country, or public savings go down, or in other words, budget deficit goes up sharply. Usually, budget deficits are the main driver of the total saving, domestic saving that is generated in the economy. So investment here could be, if you want to deal with the trade deficit, we don't want the trade deficit to go up much. We have the option of saving more, or getting the government to spend less and run a budget surplus or a smaller budget deficit, or we can cut investment. If we want to invest and we don't want to save more privately or publicly, then we have to run a bigger trade deficit. Foreign savings have to go up. And that's where imbalances come from. The governments try to pursue policies, for example, spending more, and in order to deal with recession. In that case, if they spend more, their deficit goes up. Somebody has to compensate for that. And usually countries that can have deficits, trade deficits, increase their trade deficit in order to be able to run their investment, continue their investment, and get out of recession. or generate demand for goods and services by public spending. Nowadays, trade deficits and surpluses around the world have increased sharply. China is running a trade surplus, and and Europe are running trade deficits, and this has created imbalances that is source of people think that this is not, something is wrong with our economy, that we're running a trade deficit, and we need to understand exactly what is the source. Is it private savings that has gone down, or government running too much budget deficit? And that's the key underlying issue in the current discussions. So with that, let me finish my presentation and pass it on to Vlad.
Thanks very much, Hadi. So let me reshare my screen again. Give me one moment. If I could only do this correctly. All right. So let me reshare that. Okay. So let me, sort of as sort of thanks, Hadi, for discussing the savings and investment identity. This is one of the key concepts in macroeconomics, obviously. And so let me just, sort of talk about some of the causes of global imbalances. So why do some countries, run persistent positive, and some countries run persistent negative imbalances? Well, it comes from a variety of things, right? So demographics and savings behavior could absolutely be one of them. So, if you have a country with a lot of younger folks versus a country with a lot of older folks, the savings behavior obviously is going to be different. We can talk about fiscal policies. This is one of the key determinants of the global imbalances, right? Essentially, when we look at the United States runs significant fiscal deficits. Those deficits have to be financed somehow. If they're not financed through the national saving, sort of then it has to be financed through essentially running trade deficits. Then we can talk about financial systems structure and stability. In different countries, there might be different opportunities for domestic investment. And in countries where those opportunities may be limited, or where investors could be concerned about safety of their money because the country, for example, lacks a strong system of justice and their property could be taken away from them relatively easily. So that means that people will be looking to save abroad potentially. Geopolitical stability also contributes to that quite a bit. There is the issue of the demand for safe assets. If people start viewing the world as an increasingly unsafe place, very often we see a flight to relatively safe bets in savings behaviors. For example, people might start buying gold and silver more. And you've certainly seen what happened to the prices of gold and silver over the last 2 years. But it also means that people will start buying dollars more, because dollars is widely considered to be one of the safest assets that you could possibly hold in the world. And then, of course, the structure of the exchange rate system, so the policies related to the exchange rate, will contribute quite a bit. One of them could be a flexible exchange rate system, but some countries still used fixed exchange rate systems where their currency's exchange rate is tied either to a single currency like the US dollar, or it could be tied to a basket of currencies, like some combination of the dollar and the euro. And I think that's the case in Singapore, for example. So some of the smaller countries favor the fixed exchange rate system, even though they tend to be difficult to sustain, right? And if we look and compare global imbalances between what happens now and what was happening before the great financial crisis. Before the great financial crisis of 2007, 2009, this was kind of one of the key concerns amongst the macroeconomists. This concept was called the global savings glut. It was kind of the vicious cycle. that looked at significant demand for dollars coming from Asia, which in turn put negative pressure on the dollar interest rates, right? If that's the case, then it means that there is going to be different incentives in the United States oriented towards spending more and saving less. And if you remember, right, before the great financial crisis, the national saving rate in the United States actually became negative, right? They were, consumers, you can think of private savings rate became negative. So consumers actually were spending more than they were earning. This leads in turn to trade deficits. And this again reinforces the demand for dollars from Asia. And the whole global savings glut kind of repeats itself in this vicious cycle. So, and if you look at 2006, the combined, if you divided the world into countries that were running trade deficits versus trade surpluses, the combined current account gap, and remember, current account basically includes in itself the primary component obviously is the trade deficit, but also there are payments that come from abroad, the company's earnings from other countries that are repatriated, plus the transfers, the dollar transfers between the monetary transfers between the countries. So essentially, if you looked at that current account, that was equal to roughly 2.6% of global GDP, right? Sort of for countries, sort of overall, of course, the world balances itself out, but the countries that had the negative current account gap, it was roughly 2.6%, right? And so concerns now are somewhat similar, but a little bit different about those global imbalances. The global imbalances are still there, and they recently actually, in this month, they really became a subject of additional discussion with the release of two somewhat competing papers, one from the European CEPR, the Center for Economic Policy Research, if I recall that abbreviation correctly, and the International Monetary Fund. We can note that in 2025, the combined current account gap is actually a little smaller. It's equal to 1.6% of global GDP. But the key players that contribute to this are still the same, right? Sort of obviously, number one key player is still the United States. And in the United States, we are seeing significant trade deficits. We are seeing very significant budget deficits. Dollar is used as a global reserve currency, sort of which contributes to that. There is some financial instability due to the externally owned debt, right? Sort of this is a significant risk that the United States faces. Then if you go to China, China still runs significant trade surpluses that are roughly equal to 6% of GDP, I think, towards some more current numbers. China has a relatively high domestic saving rate, which is influenced by the lack of a traditional safety net. The growth model is still heavily dependent on exports and investments rather than consumption. Consumption obviously had been growing in its importance in China, but still there is significant dependence on exports and investment. And if you look at Europe, Europe actually benefits from Germany quite a bit, right? Sort of if you take Europe overall, Europe actually does have external trade surpluses driven by Germany. So this is not necessarily true for all other countries in Europe, but Germany is kind of like the power engine of the European economy, much more than any other country. And so I think France kind of follows that, but Germany still dominates. And the typical problem in Europe tends to be the weak domestic investment, right? And all of those things essentially contribute to that current account gap. But at the very same time, the political debate across the world became a lot more heated. You obviously have seen at what happens in the United States with significant increases of protectionism, with the unilateral imposition of tariffs on many foreign goods and services, right? That became very, very significant. And so when we are starting to think about who's to blame for those issues, the number one explanation by far is the United States budget deficits. when you cut taxes and increase welfare transfers, that results in increased consumption and reduced saving. That in turn can lead to higher interest rates. That can lead to the US dollar appreciation. That can lead to higher trade deficits, right? Then another typical explanation for who's to blame is centered around China's industrial policy. When state provides very significant subsidies to select industries, we can say that we can expect to see increases in exports. And if those state subsidies don't really help industries to achieve the optimal efficiency and the products are overproduced, then essentially this excess capacity of Chinese factories is going to be dumped abroad and contribute to those global imbalances. But explanations also could be a little bit more complex. And if you look at the report from the International Monetary Funds, that's a report that says, well, macro fundamentals still dominate this problem, right? It's still fundamentally related to this domestic savings and investment dynamics, as Hadi explained. But the IMF report also notes that expectations matter quite a bit. For example, is the industrial policy really successful in increasing efficiency of domestic policy, of domestic industries, right? Is the policy permanent or is it temporary? And what do people think? How do people expect this policy to contribute to their real income in the future? Because frankly, if you have successful policies that raise your citizens' real income, that means that consumption is likely to increase, right? And this means that the global imbalances in trade are going to be reduced. But China also has another significant problem, and that problem is the real estate crisis. This is a significant contributor to global imbalances because if people in China, real estate used to be the number one savings vehicle for people, obviously. And so, and why is that the case? Well, the social safety net was underdeveloped, and China's national equivalent of the social security system is relatively new, and the population is not uniformly covered by that. People have traditionally, sort of as a result of accumulated experience over the years, can be very skeptical about saving their money in the banks because, there is the issue of bank safety. With a few well-publicized bankruptcies where people invest savers lost significant amounts of money. But also there is the over time, sort of inflation had been also significant as well that can eat away at your real savings, right? And so generally speaking, sort of Chinese folks prefer to save their money in real estate. So China has a significant amount of real estate. The real estate crisis that's been unfolding there over past years had been very, very significant. And sort of that became a significant contributor as well. And so there are no easy shortcuts in the setting, but the IMF report says, well, you still have to come back to those macro fundamentals and you have to still fix those three things that we talked about, right? How can how can the United States reduce its fiscal deficit in order to reduce the fiscal imbalances? How can China stimulate consumption more, right? So that their positive trade balances could be reduced. And how could Europe actually increase its domestic investment as well, right? And so in some way, these are kind of your typical macroeconomic policy problems. They are not easy because they require significant amount of agreement amongst the legislators and the executives and the policymakers, right? But still, it could actually be fixed somewhat, right? But one thing that we do know is that tariffs, generally speaking, tend to be very weak tools in addressing those imbalances. And you can certainly see that from the United States' current experience. Even with tariffs, the trade deficits tend to be very, very significant. And so sector-specific industrial policies is a bit of a mixed tool. Again, sort of a good industrial policy has to increase productivity and efficiency of the industry. It has to increase the incomes of people who work in the industry. And if that takes place, it could be a contributor, but generally speaking, sort of the record of the industrial policies in China tends to be relatively mixed. It's better in some industries compared to another. But if you look at the report from CEPR, um, the global imbalance, sort of that report, I think in many ways it's more pessimistic than the report from the report from IMF. And so the explanations that CEPR points to, those are still the fundamental macroeconomic issues that we've discussed that dominate the IMF policy report. But on top of that, what you have is significant global fragmentation, breakdown of international cooperation, which we all can see from the news pretty much daily, and significant negative geopolitical trends that resulted in armed conflicts all over the world, including Ukraine, including Iran, obviously. We are seeing seeds of that showing up in other countries that are becoming more belligerent than they used to be. You also have the increased influence of industrial policy, of supply chains that have been built over the years, over strategic competition that is driven by the state decisions. You still have the issue of the United States dominance of global finance and what we call the dollar's exorbitant privilege, which is the use of dollar as the global reserve currency by nations around the world, right? So essentially what CEPR says is that macro fundamentals still matter, but there are other factors that make a much more significant difference than for example, than the way how IMF views this issue. And so essentially what CEPR report says is that you have those imbalances structurally embedded in the system. Using traditional economic tools has never been easy as it requires national consensus. And we have a record in the United States to kind of coming to national consensus during significant emergencies. For example, when the global financial crisis hit, it was great to see the executive branch and the legislative branch come together to address this issue very quickly. We've seen that in addressing the COVID crisis as well, when significant policies were passed very quickly and with bipartisan support. But still, those traditional macroeconomic tools are not the only thing that must be fixed, and those other things make it very, very, very difficult to fix, right? And so, in a sense, that I think sort of CEPR's relatively negative tone of the report makes it clear that what we might have to do more and what the smaller countries might have to do more, because they have actually much more to lose compared to the large global economic players, is to start preparing their systems to increase their resiliency, sort of in the times of crisis. But essentially, I think CEPR suggests that the future crises are more likely to take place compared to the IMF report. And so, Jay, I see that you have a hand up. Go ahead. What's your question?
Thank you. So I have a comment and a question
Uh-huh.
regarding the IMF report.
Uh-huh.
There are 2 points I'd like to cover. One is around the quote unquote concern about China's industrial policy.
Mm-hmm.
So I have actually lived in China and did a number of business in China.
Mm-hmm.
How are the government incentives different than the various stimulus packages we have been using here in the States? Right, during Obama's administration, I remember the first simulation was $800 billion.
Mm-hmm.
And during the pandemic, I think that's over a $1 trillion stimulus, right? So from a macro perspective, how are they different fundamentally? Having
Mm-hmm.
a heavily government subsidies into the economy, whether to individuals or into enterprises. That's my question number one.
Mm-hmm.
Question number two is related to, I think real estate problem challenge in China is very well observed. Right?
Mm-hmm.
I personally have seen there's a lot of parallel between what's happening in that market today versus what happened during the subprime here in the state during
Mhm.
28. However, I am having a little bit hard time to really understand how that particular issue in Chinese market is affecting the global imbalance. So if you can cover those two topics, that would be very helpful.
Mhm. Okay, so let me start with the second question first. So the impact of China's global real estate crisis on the global imbalances. So, sort of remember, one of the reasons why this trade imbalance exists in China is that consumption in China is relatively limited, right? China essentially has prioritized investment and very often government-driven investment, even which makes it very difficult for us to even disaggregate what is private and what is government, right? Because there are a number of banks that are owned by governments, whether sort of like a lot of them are owned by the municipal governments or regional governments, if I remember correctly, right? And so from this perspective, it's kind of hard to tell sort of like who is financing things, right? Is it coming from the government pockets? Is it coming from the industry, right? Very difficult to disaggregate. And there is a whole industry of analysts that tries to do that, right? But the idea here is think about the wealth impact of holding real estate. So if real estate is your primary source, is your primary vehicle in which your wealth is concentrated, right? You don't necessarily have 401k account equivalents, right? You may not necessarily have a lot of savings in the banks, but your savings are tied up in your real estate. And you're seeing through this real estate crisis that the prices of real estates are at best stagnant, and at worst, they could be subject to a significant correction. So how would your typical household respond to this issue? Well, I think sort of the individual responses would vary, but overall, what is generally true is that as your wealth decreases, or if you think that as your expectations for wealth indicate that your wealth might decrease, what would you do to your consumption? You would likely reduce it, right? This is not, sort of like this is, a typical rational economic behavior. We've seen that in the United States during the great financial crisis, because, sort of as the value of houses dropped down and dropped down sometimes very, very considerably, in many states, people basically stopped spending and they started saving more, right? And so from this perspective, if this is the case in China, and sort of my view is that it must be the case in China, right? At the very least, even if consumption is growing amongst the real estate crisis, sort of your consumption growth could have been much higher than before, right? That basically means that the global imbalances in trade and running, sort of like those trade account surpluses or trade deficits, trade surpluses. This is going to stay in there, right? Sort of this is the connection. In simple terms, does this kind of make sense, Jay?
I actually have differing views on this, based on
Okay.
my personal experience, understanding how
Sure.
Chinese household own their real estate as an asset, right? The first thing I see it, the real estate market is no more than an asset class comparing to the stock market in the US. Right? So in
Okay.
the US, individuals are heavily invested in stock market, right? So
Mm-hmm.
because that market has been outperforming everything else,
Mm-hmm.
right? For Chinese consumer, it's the same choice. That is, whichever asset class has given me a higher return
Mm-hmm.
on paper, right? So that's where naturally that's where my investment goes.
Mm-hmm.
Right? So if you're comparing to what the crashes is happening right now in the real estate,
Mm-hmm.
and comparing to what can happen in the stock market, happen here in the US, right?
Mm-hmm.
The question is, does a stock market crash in the US impacting consumer consumption
Mm-hmm.
versus does that same thing parallel a housing market crashes um, impacting how they're spending. But you look at it this way, right? So the younger
Mhm,
generation in China, for example, are very, very unlikely to spending their money on real estate anymore.
mhm,
Right? The entire younger generation class is they're it's not because they're priced out. Price out is a long time. It's a long time ago.
mhm,
The problem is, well, the not the problem. The observation is most of the younger generations already have multiple properties passing on to them from their previous generations.
mhm, mhm,
I think there's some study on average, a younger generation Chinese they can inherit two or three properties from inheritance, right? So
mhm,
now, because there is a crash in that, this younger generation who tend to be the higher spending um, economic class, right? They're
mhm,
spending more money on other consumptions rather than spending all their money, all their saving on real estate, right? So I really don't really see a direct correlation.
mhm,
Yes, they are probably become a little bit more conservative in
mhm,
terms. Um, Another observation is the vast majority of the real estate in China were not um, uh, liquidable. For example, right? I Most of the investment into real estate is one directional. I mean, during the booming years, right? So people are
mhm,
buying into it, but much less number of percentage properties are actually resold in the secondary market. In other words, used home sales. I think there's a
mhm,
significant gap between new home sales versus uh, secondhand used home sales, which is very different than the market here in the States, right? So in the
mhm,
States, real estate is very liquid, right?
mhm,
People primarily buying in older homes, not the first time brand new homes. But in China, it's very different. Majority of the transactions are happening on new home sales
mhm,
because people used to think that is almost like asset investment into gold, which you hold for a long time. It always
mhm,
go up, does not never go
mhm,
down. So with those observations, I have a little, you know, I'm a little bit challenged to understand the rationale of what IMS funding is.
Oh, so I think I don't necessarily think that there is a significant contradiction, sort of in what you explain in contrasting the United States in China, right? But the idea here is that, sort of despite, sort of like the issue, the mix of the, sort of new house construction that is being sold as real estate investment trade versus the secondary market, it is essentially still an asset, right? Certainly, sort of like young people, sort of can expect to eventually inherit more real estate because they have one set of parents and two sets of grandparents, essentially, where the wealth will eventually flow down to them, right? But still, the idea is that real estate is an asset that you hold, and if there is significant correction in the value of this asset, if the market for this asset becomes much less liquid, if it's much more difficult to sell the property that you own, right? And the downward pressure on price starts building out. And government policies can kind of sort of contribute to sort of market not crashing very quickly, but still that's a significant concern, right? Sort of the general economic maxim is that your decrease in wealth is not going to positively impact your consumption. Your consumption is likely going to be, there is probably going to be a negative trend in consumption. And this is what is preventing the consumption as a share of GDP from growing as much as it could have otherwise, and still has China to rely more on dumping that excess capacity abroad and thus connecting to the global imbalances, right? So that's personally my take on that. In terms of the first question that you've asked, how are U.S. policies are different from China's policies? Well, United States policies tended to be, sort of like programs tax rebates, program or sort of like those refund checks or stimulus checks that people were getting.
That's on
Things
the
like
individual level, but on the
yeah, yeah,
enterprise level, it's very
it's a
different.
lot of the individual, right? But
On the
sort of
enterprise, it's very, very domain industry
mhm,
specific, right? You remember during Obama's administration, heavy stimulus was towards auto industry, the bank industry, right?
Mhm.
And the same thing happened during the pandemic, right? The
Mhm.
entire industrial, um, what we call the Inflation Reduction Act. It's
Mhm.
specifically targeting a few very specific industries, right?
Mhm. But I think the difference is that overall, if you look at how wide those programs are, whether they target the great majority of the players in the economy versus if they target as only a subset of those players, the very targeted support programs for some industries. In the United States overall, this is probably kind of like a larger pot of money that gets distributed a lot wider across the industry as compared to the support programs in China. At least that's my take on that. And so from my perspective, that probably is kind of like the bigger difference in there. So, and again, this is not to say that those support programs don't contribute, right? They absolutely do contribute to those global imbalances, because if governments have to run, the federal government have been running significant budget deficits over time, and those budget deficits have been financed by significant increases in the government's taken on more and more debt, to the tune where so the spending on interest is the fastest growing component of the United States government budget. Sort of that is still there, right? Sort of like that to me, sort of like is still a significant issue, but those policies also tend to kind of spread this money a little bit more evenly, despite the fact that a lot of policies do target, sort of like some sets of industries compared to the other. But, the idea here is that in China, there is still a significant contribution in a selected number of industries towards very significant excess capacity. That excess capacity basically gets out of the country, sort of it gets basically sent to the other countries at relatively, sort of at significant discounts, right? So that's some of the difference there, right? But generally speaking, sort of if you look in China over the years, China essentially, as China was growing over the past 30 years, sort of the rising tide really does raise all boats. We've seen, sort of people, do better, right? People's incomes increase. We've seen people, consume more, but still consumption accounts for a much smaller percentage of the overall Chinese economy compared to the other parts of the industry. Investment is extremely significant in China. Investment, in a sense, is you're saving for the future, right? And so that's one of the key differences. So as China grows, sort of we are expecting to see an increase in consumption compared to the lower numbers that we have, and the real estate crisis, sort of puts significant brakes on that process. Hadi, go ahead, please.
Great discussion. I just wanted to add a couple of points.
Mhm.
One is that, in fact, what happens in China in terms of policy and implementation of the policy, it originates in their growth strategy. The strategy was to grow first through exports, and then when exports opportunities exhausted, they move to invest. And the idea of the investment was, in fact, related to the growth of exports, or being competitive on the trade side. The idea was that you invest in order to lower the cost of goods, cost of production for non-tradables. A house or a building that is used for production, it's a non-tradable service because it's local. If you want to want to sell something and you want to produce it in the country, you need the housing, you need the construction in order to have a space for production and exports. This meant that they had to get a real exchange rate that is lower their real exchange rate in order to be able to remain competitive. This was reaction to what happened in Japan in the 1980s. Japan was also following the same strategy, but then was not careful about its real exchange rate. House prices went through the roof, and eventually there was there's a police rushing around in front of our house. So in Japan, that led to a major crisis towards the end of 1980s and caused a long-term recession in Japan between 1990 and 2000. China wanted to avoid that kind of situation, and they noticed that house prices being high or construction being expensive is a drag on exports because it raises the cost of production. So what they did is that they decided to be proactive, investing ahead of the time, creating excess capacity. So the motive to have excess capacity really is fundamentally coming from the growth strategy that they had through exports and being competitive internationally. Now they're stuck with the growth in investment, which has caused overcapacity. It's not just in housing, right? It's in steel production. It's in a lot of other production lines. They have invested too much. And what they really need to do, and they have been trying to do apparently, is to increase consumption. But that's not very easy. As you mentioned, there are a lot of reasons why people may not want to follow or stick to government's directive to continue consuming or increase their consumption. People worry about what might happen in the future. Their house prices are losing value, so they try to be careful in their spending. And so the point I wanted to make was that these things were to some extent predictable. It was all bad luck that some situations where there's too much excess capacity in housing emerged later on. But there were many economists mentioning this as a problem early on, many years ago, that this overinvestment could actually lead to a crisis or lead to a major problem. So thanks for.
That's an excellent point, Hadi. Thank you for bringing that up. So what I wanted to mention, of course, sort of like when you look at this, sort of this is one of the reasons why the CPR report basically talks about the strategic decisions that are pursued by the individual countries or by the individual nation states as a significant component of this crisis versus the traditional fundamentals. That is exactly it, right? And when you think that on top of that, how the one family, one child policy contributed to that crisis of the shrinking population of young people, sort of obviously that doesn't help your real estate market, sort of in terms of maintaining prices and, sort of puts pressure towards people's consumption decision as their wealth drops.
That's right. That's right.
Well, thanks for your insights, both professors. But I want to add one question or one observation. I found this concept of overcapacity in the most recent years very interesting. This is how I see it, right? I remember the time when the U.S. automakers flooded the global market, the German automaker flooding the global market, the Japanese car automakers flooding the global market. I don't remember anyone saying there's a term overcapacity. I remember the time when Samsung and Apple are selling around the world, dominating 80% of the market. I don't hear anyone talking about overcapacity. Why is this now becoming a problem, becoming an issue, rather than that certain companies, certain enterprises out of certain market are becoming just overly competitive? They are just much more competitive. They're making better products at a very good quality, and they invest long-term in their technology innovation that can sustain in the market. So this is something I found is very interesting that, for some reason, there's a new term called overcapacity that's been flowing around in economic community this is very interesting.
May I say something in reaction to that? Very good point you're making, Jay. The issue, I guess, in case of China is that China has done this so well that they have managed to rule out any overvaluation of their currency. They have kept the real value of their currency low, given the great productivity increase. Normally, when for example, Japan, when they exported a lot and they were conquering world markets, at the same time their cost of production was going up. The house prices were rising very sharply. And that essentially acted as a brake on their growth, and that did not continue. But China has been smart in trying to be proactive. So they overinvested in many assets in order to make local costs, to bring down local costs. They were worried that if house prices go up, then labor may become too expensive, and that could kill the process of economic growth through exports. They avoided that situation that Japan had run into. But then, alternatively, this other problem emerged, that they are now stuck with overcapacity in many sectors. And that's what other countries seem to call excess capacity, or too low cost of goods. China is driving out a lot of countries out of the market because of the major excess capacity that it has. Japan did not have that kind of situation. They had great capacity in exporting, but the cost of domestic goods, the non-tradables, went up sharply, and that acted as a brake on economic growth in Japan.
Jay, did you have another question? I see your hand is raised.
Oh, sorry. No, I'm done with my question.
Okay, all right. Yeah, so thank you, Hadi. And I think, sort of like, if I wanted to add my 2 cents, I really don't have very much to add to what Hadi said. But part of it, sort of comes from, sort of if you're looking at the decisions of, multinational companies, as large as they might be, right? I think the sense is that if you looked at this process in, sort of in Japan and in some of the other countries, right? So there is one issue of a company, sort of building up significant capacity and significant systems to produce goods and services that are valued relatively, sort of, and producing them relatively, sort of cheaply, and essentially, increasing their market share in other countries based on those private corporate decisions. Versus in China, it's kind of unclear when you're looking at the capacity. Well, I mean, I don't know if it's unclear, but a lot of the capacity decisions are basically a result of strategic decisions by the state, right? And potentially very, very significant supports to those industries, where it's hard or impossible to figure out where that comes from the typical private market transaction, whether it comes from the states, given that the number of lenders are owned or very significantly influenced by the government. And, sort of, and in fact, that China, a lot of their lending programs depend on the preferential treatment, by the central banks, where, sort of, instead of, decreasing interest rates across the board, sort of there could be lower interest rates that are extended to some industries compared to others. All right. Folks, any other thoughts or questions? Don't be shy. We'd love to hear your comments and your questions.
How often do we have this kind of thought-provoking discussions? This is exciting.
So we normally have those seminars every month, and generally speaking, we have them every second Sunday of the month. This month is a bit of an exception because we had a bunch of holidays and sort of religious events that took place. sort of including the Catholic Easter and the Orthodox Easter. So we're doing it the third Sunday of the month, but we do have it monthly. We have a calendar in the on the page on the group page on LinkedIn, and you can also download a calendar invite where you can add it to your calendar for basically for the remainder of this year.
Gotcha. I
Mhm.
appreciate it.
All right.
I made a suggestion early in this conversation. I
Mhm.
really enjoyed the opening that you presented. However, I feel that view is more of a nation state to compare to nation state economy versus right. But if you look at the global economy, the behavior is actually much more complex, much more intertwined than nation state versus nation state. Oftentimes, there are uh, very large, influential global multinationals, including some of the wealthy individuals, right? Their behaviors, their balance sheets are not necessarily driven by nation states, right? They don't really act solely upon a particular nation or state. Their decisions are usually driven by tax incentives, policies. We see this happen all the time, right? And these are very, very large multinationals, and they, as a strategist, right? So everybody is helping a business to right position themselves. How do you realize your earnings, your investment, your expenses, as long as legally possible allow you? This is why Deloitte, McKinsey, all these big firms are happening, right? So I'll be very interested to really kind of look at this macroeconomic view from a different perspective, adding the decision making of those um, multinational actors who does not necessarily see the interests of a particular nation. They're really seeing the interests of a particular enterprises, right? How those people's decisions, their behavior, are acting or impacting how we look at this global imbalance.
Very good point. Very good point.
Yeah, it's an interesting question, and this kind of points us to this traditional separation of economics into microeconomics that looks at the decisions made by individual economic players, such as consumers and firms, right? Versus sort of macroeconomic decisions, and the issues in those are very often different, right? Because if you look at the decisions made by corporations, the bigger issues in there are, sort of issues such as the market structure where they operate, obviously. So are you operating in a market where there is a lot of producers, a lot of consumers, where the goods and services that you're producing are fairly, sort of similar to each other and could be substituted for each other relatively easily? Are you operating in markets where you have obtained a significant advantage, either through a cost reduction strategy, right? Sort of which tends to be very difficult for a lot of company, where you could have obtained an advantage through through a strategy that looks to differentiate your product and make it very, very different from what others produce, so that substituting your product by product produced by somebody else is a lot more difficult, right? You're looking in terms of figuring out where to make them. You're obviously looking at the both sort of like the market conditions of those individual markets and the potential government support of what you do. But there is also other things at play, such as things that typically contribute to economic growth, like the availability of the labor force that is sufficiently educated, right? And one thing that China had done really well is that we can obviously see that the cost of labor in China has increased, and it has increased significantly over the years. And normally something like that, if you were, sort of like that could have been very difficult for the company, right, or for the country. But what we also see in China are significant increases in the levels of human capital, in the intensity of the capital use, and thus in the productivity of this labor. So your labor might become more expensive, but your labor also becomes more productive, and so you're still maintaining this optimum, this really strong ratio between the cost of labor and the labor productivity, right? And sort of China had done all of those things relatively well, and it avoided the pitfalls of both Japan and to some extent some of the problems that South Korea experienced as well, right? But again, sort of those successes often lead to different types of problems, and this is the fun part about macroeconomics, I guess, where typically every crisis that we see is quite a bit different from the previous crisis. There are some similarities, but there are also significant differences. Sort of it's an ever-evolving situation that that contributes to that traditional joke about macroeconomics, right? We say that our exams in macroeconomic courses remain the same, but the right answers change every 10 years or so.
Well said. Thank you both very much.
Thank you.
All right,
Thank you
excellent.
for the questions.
All right, fantastic. Thanks for joining us. So it looks like we're a little bit past 2 o'clock. So folks, thanks very much for joining us. It's much appreciated. I hope you enjoyed the presentation. We hope to see you in future sessions, and I'll post the recording of this session on YouTube within a couple of days. Thanks a lot and see you soon.
Right. Thank you. Thank you.
Bye-bye for now.
Thank you. Bye-bye.